I'm Rob Booker, and it is Thursday, March 11th, 2010. And this is a special webinar with FX Street on quarter two, 2010 volatility and whatnot. And I'm super excited to be here with you. Really excited to spend some time with you this morning, today, this afternoon, wherever you are in the world. I'm going to change and expand my charts a little bit. Is that size of that chart, is that going to work well for all of you? You should be looking at a Euro-Yen chart. It's a 1 hour Euro-Yen chart. And we're looking at the currency pair hanging around the 800 simple moving average. Today what I'd like to do is talk about what some of the major themes of 2010 could be. Talk about where we might see activity, which currency pairs could be the most active, and then actually go through some currency pairs and look at some trades that might be setting up, and some trades that I might be wanting to take, and some things that you might consider as well, and be happy to have requests for currency pairs or other things that you want to look at. I think the major story of 2008, 2009 was the mortgage crisis. It was the U.S.-based crisis that sent the whole currency market into an absolute frenzy. And don't you think that 2008 and 2009 were dominated by the currency crisis? I mean, like the mortgage crisis, the banking crisis, the mortgage-backed securities crisis? And that's a smile that says yes. I have a very shy participant coming in on the webinar today. That's absolutely funny. I don't think that's the story for 2010, do you? I don't think that the mortgage-backed securities crisis is the story for 2010.
What's the story going to be?
The story is probably going to be the euro. I think the Eurozone, I think that's going to be the focus. I think that banking in the Eurozone is going to be the focus. I think that interest rates in the Eurozone is going to be the focus. I think economic strength in the Eurozone is going to be the focus. I think that the failure of Spain, Italy, and Greece to participate fully and responsibly in the Eurozone, blah, 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 is going to be the focus. And what currency pair would we like to see fall the very most?
The euro dollar.
The euro dollar? You have to speak all the way into the microphone. The euro dollar is going to be absolutely the focus. And Mao from Brazil is saying that he wants the euro up. What do you have to say about that?
He wants it up?
He wants the euro to go up. How far do you want it to go up? I wonder how far he wants it to go up, because if I gave you a question between up or down, if I asked you, is the euro going to go up or is the euro going to go down? What is your initial immediate reaction?
My initial immediate reaction is the euro is going to either go down or it's going to stay the same.
So it's not, I mean, in your mind, it's very difficult to imagine a scenario where the euro dollar ends up rising 1,000 or 500 pips from where it is right now.
Right.
That's almost impossible to imagine, in fact.
For me, at this point.
If you consider the problems that are going on in Europe right now that we have just found out about, I mean, if you look at these are macroeconomic problems. If you consider the fact that we've just barely started talking about Greece in the same sense that the mortgage-backed security crisis, you know, the first 2 or 3 months of that, we weren't done seeing the effects of that crisis within 2 to 3 months. We were done just talking about what the solutions were going to be. And frankly, we don't even have solutions yet for the Eurozone crisis. I mean, we have discussions and we have, you know, bond issues and we have things like that, but we're not out of the woods yet. And we're certainly, even if we are out of the woods on Greece, we're not all the way out. Bye, Shana. We're not out of the woods on like, say, for instance, the Spanish problem or the Italian problem, or, I mean, we have all kinds of issues that are still coming out. Portugal is mentioned. Portugal is very small, so it's hard to imagine that Portugal is going to be, you know, bringing down the rest of the Eurozone. But here's what I have to say in particular is, given the fact that we've just started some of those problems, this is the year of the euro, in the sense that it's the year of the non-euro. It's the year of the dollar against the euro. but it also could be the year of the Japanese yen against it. It could be a fairly significant move. In particular, the euro dollar seems the most susceptible to problems that could continue to come out from the eurozone. Banking problems, country problems, debt problems, and so forth. While the rest of the world tries to come out of this worldwide economic collapse, you have, on the other hand, you have the eurozone that isn't really coping as well with that. So that's my prediction, not only for the second quarter, but it's my prediction for the rest of the year, in fact, that I think we're more likely to see the euro at $1.15 than we are to see the euro at $1.50 again.
Do you think that you're going to see major changes in the eurozone? Do you think that you're going to see currencies drop out and some of the old currencies return, or any major things that could upset the balance over there?
You know, there's a lot of questions. There's a lot of debate right now about, you know, are the problems so bad in the eurozone that a country either gets kicked out, or, like Germany's been part of this speculation, that Germany would decide to pull out and say, well, listen, I'm a PhD level economics student. I don't want to go to school anymore with kindergarten level economics students. I mean, and that's
until they have a bad year.
Until they have a bad year, and then they're grateful to be part of the eurozone. And by and large, every country that's been part of the eurozone has benefited enormously from price stability in particular, which was kind of the reason that the whole thing was set up in the first place. I mean, the eurozone wasn't set up so that everybody could help Greece become a successful economic powerhouse. I mean, I think when they created the eurozone, they knew what they were getting into. They knew that some of this was a possibility, and they even talked about the fact that how are Italy and Spain and Greece going to cope with the onerous, you know, debt requirements and all kinds of stuff. And we're just seeing that now play out. And so last year when I was in Barcelona for the Most Excellent International Traders Conference, actually, in fact, we're going to do an online version of that International Traders Conference in the coming weeks. We're actually going to do a version of that for a webinar base, because it was an excellent speaker lineup, except for me. And everybody's going to actually make their presentations and do them online. So if you're out there listening right now, that's an important thing to maybe be a part of. It's not just on fundamentals, Ash. We'll get to some technicals as well. The point is that when I was there, I just was completely bearish on the euro. That was back when we were sort of still looking kind of silly for selling the euro. But that was just our fundamental outlook, was that the eurozone was going to have to cope with some of these problems. And these problems were eventually going to catch up, and they're catching up now. And so the euro at $1.35 or $1.36, sure, it could go back up to $1.40. Absolutely. In the midst of downward trend, a currency pair can recover, come back up, and it can do all kinds of things. But practically speaking, I am an absolute fan of the euro dollar at, say, I don't know, like $1.30, $1.25, $1.20.
Lower.
By the end, lower. No whammy.
118 is what I'm holding on.
1.18. That was margin call about, 50% of the people that I know.
I had it in my head that when the euro hits 118, the recession will be over. Good times can roll again.
I mean, that's a bold prediction. That's 1,800 pips from where we are right now. But we are 1,400 pips from where we were last year. And so, and you want me to give it a time frame, Tegra? I say by the end of the year, we're going to see the euro at least at $1.30, and perhaps even much, much lower than that.
Well, my limited experience with the euro tells me that it when it comes to time frame, it can make up its mind and make a major change so quickly.
Mm-hmm. Absolutely. Well,
so quickly.
What kinds of things would prop the euro back up? I mean, look at the euro here on the 4-hour chart. It's a pretty clear downward trend. This is what the moving averages look like, in my opinion. The 62 is in red, the 200 simple moving average is in blue, the 800 simple moving average is at the top. way up there at $1.44. This is what the currency pair looks like typically when it is primed and ready for a burst upwards back to a previous high and above the 200 people moving average for the first attempt to get back up again. It's usually a failed attempt, technically speaking and statistically speaking. It hasn't been away from the 800 people moving average long enough to really start to have any concerns. And the currency pair could very easily rise up to about $1.38 and then top out there. That would be where my next sort of area to resell or go bearish again on this currency pair would exist. I think that
To resell?
to resell, yeah, $1.38, something above the 200. It looks like things are squeezing together here down at the bottom. It looks like things are tightening up, that we're moving in a sideways pattern that I have typically called tombstone, or others have called a squeeze box or something like that. It's squeezing together, it's tightening up. The currency pair has started to sort of go stale, and the market participants are unwilling to push it outside of that zone. But it will get pushed out of that zone. My thought is it will most likely get pushed upwards out of that zone. And that's going to get caused by, negative U.S. information or positive information about the Greek crisis or whatever. And you could get pushed up temporarily, and then as soon as we get some good news out of Europe, it'll be time for them to follow it up with some bad news out of Europe. The best time to give out your bad news is over the weekend or right after you've given some good news. And then we could see a further decline in the euro. I think if it falls below the lows that it's created recently, falls below these lows here, now, later, before it goes up or whatever, if it goes below $1.34, it's over. Like this is now going to go on the way to $1.30 in my opinion. We'll go all the way down to the round number. If you're sitting on top of a long euro dollar position and you're hoping that what you have is a 30% drawdown that doesn't go to 40% or 50%, and it crosses that barrier right there, you need to think about some strategies for preserving your capital as opposed to thinking about strategies to grow your account. That's just my 2 cents. I think that when you talk about volatility, and you talk about fundamentals, and you talk about statistical analysis, all signs are still pointing to the euro declining. There's an interesting comment here. Money Magnet says that I think that since the U.S. and the euro have some of the same problems, the price logically should get closer to parity. Your opinion, Money Magnet, is shared by some of the largest banks in the world, that given the state of the world economy being as bad as it is for as many countries as it is, it's a little bit out of control to see the euro at these levels that are, the euro is still trading at a premium to the U.S. Our friend Max in Germany, I doubt he's here, I wish he was, wrote me and he says he had done an analysis based on tax levels and debt levels and economic fundamentals, and he said, the euro retracing to $1.35 or whatever is just bringing it into the region of fair pricing. I mean, it's just barely getting into the region of actually being priced fairly. And do we price things fairly in the currency market? No, we price things fairly and then we go excessive. We always go to extremes in the currency market. That's why you and I are here right now, because we like the fact that it doesn't just go to parity or fair price or whatever. It goes much further than that. Kegra asks, as you were talking fundamentals, do you think China doesn't have a role in the USA euro price? The answer is that there doesn't really seem to be a lot of room for China in a discussion about the euro and the euro dollar in particular. If you have China diversify its currencies, and boy, oh boy, do we ever hear that once a year. We hear that China's going to take a huge portion of their reserves and they're going to start to diversify those reserves and they're going to start to buy a basket of currencies. They're not going to get rid of the dollar. That would be the equivalent of, China taking its stash of nuclear weapons into the center of the country and then blowing them all up simultaneously, just for the sake of trying to hit the U.S. from there. I mean, that is absolutely positively, they're much smarter than that. They're not going to do that. They could threaten to do that, and that could bolster the euro. And maybe a year from now, after we've seen the euro drop, maybe that's the storyline that picks the euro back up again. But in my opinion, we're not going to see China participate in a euro dollar decline. I think China's got other things to worry about. To the extent that they discuss currency rebalancing, they do it for political purposes. They don't even do it for economic purposes. It's always a political threat associated with something like you know, our demand that they don't tap the phone lines of political dissidents, or, you know, have a free press, or let people Google for porn or whatever. I mean, right? I mean, that's what China's all about, is controlling their economy. Okay. Kendra, it might be urban legend, but it is eventually going to be, those chickens are going to come to roost. Eventually we are going to see a discussion about China and the U.S. I just don't think that it's necessarily going to be as big of a story now as it is going to be later. I think we're still in the midst of the story about the Eurozone economics. I think this is, without a doubt, the story of 2010. The euro dollar is the story. I think, in 2008, 2009, you had stories about the Australian dollar and the New Zealand dollar. You had stories about the world economy. You had stories about the pound yen carry trade collapsing. Those were all major, you know, stories that we had. And the main one this year, I think, is really can the Eurozone survive? Speculation around that. Of course it can survive. And will the euro survive? Speculation about those things should drive that currency down. Janata says that he or she is a bit skeptical to that dollar will appreciate against the rest of the world due to the massive public debt. Now, Janata, would you consider me your, you don't consider me your enemy, right? Janata, you don't consider me an enemy. You don't consider, I'm not a mean person, right? I just want to make sure. Okay, great. Because I think that opinion is absolutely ridiculous. And I don't mean that as an offense to you. I think that is, I think that's a common refrain. I think that massive public debt, and it's just an economic point of view, and I completely know that there's another side of the story. Do you mind if we take a moment, we go through that side of the story?
Yeah.
Here's the side of the story. There's this theory that says that there has been a massive amount of public debt incurred in the midst of an economic stimulus package after stimulus package. I think unfairly that the most of that blame has been placed on the shoulders of the current president of the United States. However, George Bush and Barack Obama and the Republican and the Democratic Congresses both pushed through tax cuts, war spending, economic stimulus packages, Medicare spending bills, all kinds of programs that massively increased our public debt. In particular, over the course of the last 24 months, the concern has been, and you can hear it expressed most articulately by the Tea Party people, or the right wing of the Republican Party, or the former right wing of the U.S. Republican Party that is now a party unto itself, people who believe that massive public debt is going to create the downfall of American civilization. And particularly Ron Paul of Texas, whose brilliant, articulate, and well-researched writings point to the fact that whenever the government pushes that much money out into the economy, sooner or later you're going to have too many dollars swirling around, and it will cause a mass amount of inflation. Too many dollars swimming around are going to cause inflation. The problem is that the majority of this, and this is my point, Janata, the problem is that most of that public debt that was incurred went and got stuck on the balance sheets of major banks. Goldman Sachs, AIG, JP Morgan, Bank of America, and on down the line. Most of the money that we're talking about in public debt for stimulus packages ended up shoring up the balance sheets of major U.S. banks. It wasn't lent out. So it's not just that more money was created, which is inflationary if it makes it out into the economy. The problem is that money never made it out into the economy. It just got stuck inside of the banks. And that's why you don't see a more rapid turnaround in the U.S. economy than you have, because the stimulus money really didn't stimulate anything. It stimulated the balance sheets of banks so that they didn't fail. Now, there's two lines of reasoning. One says it's not fair to give private money to public entities that should have survived on their own. And then the other argument is, if you look at the Great Depression, 10,000 banks failed from 1930 to 1932. And why did 10,000 banks fail? 10,000 banks failed because the government failed to inject liquidity, shore up the balance sheet, and provide the liquidity needed out of political pressure that they weren't supposed to shore up institutions that had been irresponsible in their lending. And what happened? It contracted the money supply, and all of the liquidity went out of the system, and deflation just took hold. And way late in the game, 1933, 1934, the government finally caught on and started injecting stimulus into the economy. But by then it was too late, and we were already in the midst of an almost intractable problem that was only solved perhaps by a war. What we have right now is a situation where at least we prevented banks from failing and from contracting the money supply even further. The problem is that stimulus was not really ever intended to create inflationary spending. It was created to make sure that you and I didn't lose our deposits at our banks. And so we've got step one of the stimulus, and that's why there's still discussion of additional stimulus packages in the U.S. because there just still hasn't been enough of the stimulus that has reached consumers, and there's a fear that consumer spending will drop precipitously and that we could see another double dip second recession in the United States because none of the money made it to consumers.
Which would lend further support to the U.S. dollar against the euro, for example?
Yeah, which would lend further support to the U.S. dollar against the euro. What's happening right now, in fact, and we're talking about volatility and fundamentals and some technical analysis in a moment, but what we're really talking about here is the fact that the United States of America is actually at the tail end, they think, the Federal Reserve, many economists, just about everybody who's on in the evenings on CNBC, believe that we are at the tail end or end of the recession. And that the Federal Reserve ought to keep interest rates low, but probably is headed in the direction of slightly raising interest rates within, I'd say, the next 2 meetings of the Federal Open Market Committee. Now that's an issue. If they raise interest rates even slightly, what they're signaling to the market is we've come out of the worst of this and we're ready to start raising interest rates. Raising interest rates takes money out of circulation, or at least it's intended to. It's intended to put more money on deposit and less money into circulation. It's supposed to make lending more expensive so fewer people borrow money and then spend it. And generally what happens during the course of this time, even though that's what the intent is, generally speaking, it's a signal to the market that the economy could be improving. And so it could actually have an unintended consequence, which is what happened in the late 90s and the early part of the 2000s. People can hear the Federal Reserve saying we're at the tail end or the worst might be over. And the market can actually improve. And even though interest rates are going up, you can actually see an improved economic climate. By artificially keeping interest rates low for too long, the Federal Reserve, in my opinion, does 2 things. It prompts too much borrowing at a low interest rate that can cause problems later on. But secondarily, for an extended period of time, it can actually have the adverse effect of sending a signal to economic participants that the economy is still really weak and they should be timid about spending. By raising interest rates slightly, they keep interest rates at a very low rate, and then they actually start to send signals that the economy is getting better. And so I think that the end of the recession or a bigger pickup in the economy really actually comes if the Fed raises interest rates just a quarter of a basis point, and that's when you could see some real movement. Simultaneously, the Eurozone is not going to be in a position to raise interest rates as quickly, so the U.S. is going to be raising interest rates faster than the Eurozone, I believe. And if that's the case, then you have the U.S. dollar having a higher interest rate than the euro, and it's one more argument, as you brilliantly noted, that the U.S. dollar could actually improve against the euro. I don't see very many arguments for how the euro does well unless the Middle East or China steps in and actually does begin to actually diversify their currencies. And why would China pick the euro right now? Why would China pick the euro right now? I mean, aren't people smarter than that?
Well, can you talk about the intricacies of the monetary policy in the Eurozone where all of the different countries have to go through other countries to even borrow money, and the bank, it doesn't flow as easily through as it does in the U.S., for example. Is that correct?
Yeah, I mean,
I don't really know how that works. I just have the sense that it's a lot more complicated in the Eurozone for them to move money around.
Well, imagine for a moment that California's economy is larger than Greece's. At least that's probably what's happening. And, you know, California is in the midst of probably the worst recession of any U.S. state ever, with the exception of probably West Virginia or Mississippi, which have been in permanent recessions for a long time. But California has higher unemployment than any other state probably in the union, and California has, you know, massive problems. But shoring up the balance sheet of California is a much easier thing to do. It's much easier for the U.S. government to step in and make a difference in California. But imagine for a moment
that it is.
Well, imagine for a moment that the only way California could get out of its trouble was for Colorado or for New York to lend California money. Now, why in the world, in the midst of a worldwide economic recession, would the state of New York lend money to California? They would basically say, we're not part of the same borders, but we have a federal government that steps in that moment. Well, the problem is that the European Central Bank really represents its member banks, whereas the Federal Reserve represents the United States of America and really has a role to play. The European Central Bank can only have participation based on the willingness of its member countries. Now we're talking about countries, languages.
Right.
I mean, it's a big deal here, and it's a lot harder to imagine in your mind New York shoring up California than it is the federal government. Well, if we talk about Europe bailing out Greece, we're really talking about Germany bailing out Greece. And that is politically very unpopular. Imagine if you lived in New York and your public services were cut and your services for education were cut, that your economic stimulus packages for your own state were cut, that your road work was cut, and that your hospitals were closed, and that schools didn't stay open as long, and that your beaches didn't have as many lifeguards, and your state parks were closed because you didn't, and the reason was that you were helping out California, you'd be like, no, California ought to take care of itself. And that's what we're looking at in Euro, is that there's a cultural and political problem having one place bail out the other. And the Eurozone was created with the European Central Bank specifically for the purpose of trying to rectify that, trying to get a greater amount of cooperation between those countries in the case of something like this happened. And because they could get greater price stability between countries, and that would encourage trade. If a Big Mac cost the same amount between borders and whatnot, or started to get closer, you could more easily trade between the borders, and it would be, there'd be less friction when doing that. An unintended consequence is that there's a lot of backlash from one country really bailing out another.
Well, that is really interesting, and it kind of answers the question that I saw a page back there about Europe and the U.S. being similar, and I think that's where even if their economies started to improve at a similar pace, they have a few more hurdles to get over to make all of those things happen that we're talking about than we do out here.
Yep, they've got a lot more hurdles, and that's why it's coming back full circle.
And that's why I think the dollar is going to beat the euro.
Yeah, and a lot of people say, and we've both heard this. People say a lot of times, well, gosh, what's so special about the dollar? I mean, isn't the U.S. in major fiscal? I mean, isn't the debt just out of control? Isn't public spending out of control? Isn't it mismanaged? Isn't it this? And the question isn't whether the U.S. is better than Europe.
Right.
The question is, which one is less bad? No.
Right.
If you want to pick an economy that probably over the course of the next 10 years is more insulated from worldwide economic problems, that has the greatest amount of, sort of insulation or protection against it, you'd probably want to pick Australia. You'd probably want to pick something that has a huge amount of natural resources and that sort of benefits when times are good, but doesn't get
sort of keeps quiet when everybody's throwing stones.
Now, I was bearish on the Australian dollar for the last 3 months or so, and if you go back to Forex TV, I did a long series of interviews where we kind of talked about the reasons that the Australian dollar was overpriced and that people had priced in too many interest rate hikes and whatnot. Let's move to the Australian dollar and talk about some things there. That's the macroeconomic view of the euro. And we'll just do let's see what Philip says. What could be the effect of the proposed global transaction tax and decreasing leverage to 10 to 1 or below initially in the U.S.? Well, Philip, the global transaction tax and decreasing leverage to 10 to 1, I don't mean to get off topic here, but if you just go to robbooker.com, on the home page there, on Monday I'll be doing a webinar about exactly those issues, and we can talk more specifically about those. I'm happy, Philip, to just give you a short answer, which is leverage in the U.S. will not be decreased to 10 to 1. It's not going to happen. Not going to happen. and we'll talk more about that on Monday. I don't believe that's going to happen. I don't believe that's on the horizon. And what would be the effect of a proposed global transaction tax? I think that if there's a global transaction tax and it theoretically affects the forex transaction, retail forex traders will be exempted from that transaction tax. Okay. Here's the Australian dollar, US dollar on the daily chart. As you can see, we did have a dip over the course of November and December, and there was a small drop. But that drop went down 600 points or so on the Australian dollar. But it has still remained and been able to stay above 90. That's a critical level for me this year. Does Australia, or does it not, have the natural resources necessary to sort of stay out of and prevent itself from experiencing the same damage that all the other countries in the world economy do? And the answer to that is it's looking like it does. There was a brief decline, which we kind of talked about, and there are a lot of reasons for that. But now if it rises and closes above this long-term daily trend line here, which it's very likely to hit, if it rises up and goes above that level and then above 94, we're going to parity on the Australian dollar. And the reason that we would go to parity, fundamentally speaking, is that of all the central banks in the world today, of all the major central banks, Australian Reserve Bank, headed by Glenn Stevens, or the New Zealand Reserve Bank, the Bank of Canada, the U.S. Federal Reserve, the Bank of Japan, the Bank of England, and the European Central Bank. Of all of those entities, the Australian Reserve Bank has signaled a willingness that is greater than at any other point in time or any other country right now of raising interest rates. In fact, they already did it once or twice at the end of last year, and they've signaled that they will aggressively move to contain inflation in the midst of what is and could become very quickly again great demand for raw materials in any kind of economic expansion which continues. So there you have it. I think that the Australian dollar could be a secondary story of the year, that they could sort of come out of this whole worldwide economic situation much better off than the rest of the world. Anis says, hello, Rob, attending from Dubai. Heard today radio and worldwide billionaire list with Warren Buffett on third rank. Wonder why there is no trader up there on the list. Please help me get a better understanding. A better understanding why there's no trader on that list. I don't know. I mean, I think traders typically, traders typically are striving for what they call FU money. And you understand what FU means. F-U-C-K money. And what what FU money is, it's a certain amount of money at which point they can say FU to the rest of the world and they can just go off and do their thing. And traders don't necessarily accumulate money for the sake of accumulating money, and they're not running a public company like Warren Buffett is that is dependent on that. Warren Buffett also is wired differently. He's wired to accumulate and preserve and accumulate and preserve, whereas traders are wired to accumulate and spend. and so,
accumulate and enjoy life.
Enjoy life. And so what the real difference here, Anis, is that there just isn't most traders who are ultra successful, and you could put traders from Goldman Sachs on the list or whatever, when they reach a certain amount of money, 10 or $20 million, that's FU money, and they're out. They're out. They go start another company or start a hedge fund or manage their own money or whatever else. But you could put, what is it? Paul Tudor Jones on the list. I'll think of other traders sometime today. Who's the guy? George Soros is probably on that list. He's a trader. So you've got a fair number of people on that list. Steve Cohen is worth billions. He's a trader from SAC Capital. There's also a lot of people who trade that don't make the list because a lot of what they do is very private. So traders really aren't wired. John Paulson, very good, very good. That's another one. John Paulson, who runs the hedge fund out of New York. Yeah, he made a loan on the mortgage-backed security crisis. His payday alone was $5 billion or $4 billion, $3 billion. So and some of the very best traders, John Paulson, notably amongst them, are very low profile individuals. They don't want anything to do with, lists in a magazine or whatever else. So, Bill Gross of PIMCO. Bill Gross is one of, the wealthiest people around. He's not I don't even think he's a billionaire, but, his annual pay package was something in the order of $10 to $20 million over the course of the last 5 years. So I don't know what you consider, rich enough, but, most traders, once they reach a certain amount of money, aren't striving for additional. All right, back to the Australian dollar. But what happens? I mean, Steve Forbes declined to be on his own list. That's fine. What's the scenario that would play out whereas the Australian dollar would suffer, or the Australian dollar would come back down? All I can point to is if the world economy starts to falter again, and we have a double-dipped recession where the problems sort of become much bigger all over again, I think that reduces demand overall for products and raw materials. And I think that that's what causes the Australian dollar to perhaps decline. In the midst of a global economic meltdown, the dollar will improve against every currency because the dollar is a safe haven, because U.S. government bonds are the safe haven, and they're denominated in U.S. dollars. So you have to transfer your currency in dollars, and then you have to buy the bonds. One of the greatest ways to raise public money to finance public debt is to denominate your debt in a foreign currency, as New Zealand has done in the past and whatnot. It makes it more attractive and easier to buy for foreign nations, but it exposes the country that issues the debt to all kinds of currency exchange rate problems. That's not likely to happen either. The Australian dollar would really only suffer if you consider a massive global economic meltdown. You could also have a situation where China increases demand so greatly for raw materials that the Australian dollar improves. That's a typical line of reasoning that no matter what else happens in the world, China is still going to buy so many rocks from Australia that it won't matter. That's simply false. It's simply ridiculous. China does not buy enough to maintain Australia's economy. It doesn't happen like that. No country is an island. Getting back to U.S. debt, just good business today in USA. Printing companies are up, good commodity. U.S. dollar is a safe currency only as long as investors will believe that the U.S. can pay all of its debt, and that is absolutely true. There will come a point in time where the U.S. will have to simply raise taxes or print money in order to pay that debt down, devalue the currency or something else. That's absolutely positively a possibility. The most volatile currency pair of 2010 will probably be one of those two currency pairs that we discussed, but always a close front runner for volatility is everyone's favorite, the Orient Express, the pound yen. Many of you are familiar with the pound yen on an intraday basis and are familiar with this currency because you trade it regularly and you trade it responsibly, of course. And the pound yen has been pummeled, it's been kicked around, it has been trashed on, dumped on, hit on, every kind of on you can have. This currency pair has been whacked and blown up, and it is really, really time that we start talking about what happens next with this currency pair. It is in the midst of a decline yet again. It has been as low as, in 2009, 118 or so. Could we see a return to that level, and what would cause it? It has been as high in the past 2 years as 163. Could it get back to there, and what would it take? According to the old-fashioned Arizona rules, the 62 exponential moving average, which is red, is below the 200 simple moving average, which is blue, which is below the 800 simple moving average, which is that black dotted line. We have seen the currency pair already take its first sort of fake move towards the 800 above the 200. That is typically followed by another leg, another impulse wave back down. I'm inclined to say that unless the world economy improves dramatically, we're likely to see this currency pair fall further. In fact, we're probably likely to see this currency pair fall back down into the low 130s, maybe even into the mid 120s. And if it breaks the lows of 118, we're likely to see 110. That's going to require a double dip secondary recession. However, if U.S. interest rates start to improve, if we see an interest rate hike in the next 4 months, even a small one, signs of a recovery, signs of a stock market improving, and confidence returning to the market, hiring returning to the market, this currency pair will very easily by the end of the year reach 106. Very easily. And the early warning signals of that happening would be interest rate hike, job numbers going positive for the first time, and the stock market improving and staying above 10,000 and perhaps reaching above 11,000. If you see those types of things happening, you will absolutely positively see this currency pair return to 160 before the end of the year, and then possibly make a bold run back up all the way to the 800 simple moving average. If we double dip though, if the job numbers get bad again, if the U.S. Federal Reserve notes that they can't raise interest rates because things have not improved enough, and if the U.S. stock market drops and stays below 10,000, we're looking at a depressed worldwide economic environment. And the fact of the matter is that this currency pair is as susceptible or more susceptible to those kinds of situations than any other currency pair out there. This tracks better with the S&P 500 and the Dow Jones Industrial Average and the worldwide economy just about better than anything else. It also will track the euro dollar to a certain degree. If the euro dollar starts to fall on bad economic news about Europe, it's likely that this currency pair will follow, and that this is a very worldwide economic sensitive currency.
You know, I've been thinking about that, Rob. I wonder if at some point you're going to see more unraveling of that correlation, just because they have different barriers, and different things are going to be good news and different things are going to be bad news for them. I really wonder if that's possibly going to be less of an effect.
In the midst of a worldwide economic recovery, it's possible to imagine the euro dollar falling because the eurozone is not catching up with the recovery as fast as everyone else. But see the pound yen move upward on the backs of the recovery. The pound yen is typically a proxy for risk, meaning in the carry trade, it wasn't just the carry trade. It wasn't just that this weird thing called the carry trade was exploding. It was simply the fact that people had borrowed money from Japan over the course of a long period of time, and they needed to pay that money back. And because they needed to pay that money back in yen, they were basically closing positions, selling real estate, buying yen, and then selling British pounds to pay off those carry trades. Well, in the midst of a recovery, low interest rate currency pairs may be the clear losers, like the Japanese yen. In the midst of that, a lot of people could borrow yen, sell them, get other currencies, and invest again at low interest rates. What typically happens in an economic meltdown is there's a flight to safety to low-yielding currency pairs. Low-yielding currency pairs included in the past the Swiss franc, the U.S. dollar, the Japanese yen. There's a flight to safety in low-yielding currency pairs. That's not just because low-yielding currency pairs are seen as safe. It's also because a lot of loans were taken out in those currency pairs at low interest rates and are now being paid back. Because people are worried about the economy, they want to pay off the debt and stay, basically flat. But in the midst of an economic recovery, U.S. dollars are going to be cheap, and so there could be a significant demand to borrow those and then sell them. And Japanese yen in particular, go borrow 100 million Japanese yen and then go buy real estate or whatever else. So we could see the pound yen go up while the euro dollar goes down. It's hard to imagine the euro being a funding currency like the US dollar has been, or like the Japanese yen has been. Money Magnet says, demo if you're a beginner, but if you're testing maybe $100 for a mini account, that's fine. Spending big on a dollar, the cheaper it gets, blah, blah, blah. Those are all excellent, wonderful, stupendous comments. Let's do open question time. Anything you want to ask? Keep it there for now. Let's see what kind of questions and comments. And while I'm looking for questions, hey, James Chen, are you here? Is James Chen around? Is he in the room? Is that possible?
Who's in the room that I might know?
Jim. I don't know if Jim is here, but it looks like he's here. James, okay, if he's here or not here, James's new book came out, I think it was at the end of last year, at the beginning of this year. Absolutely fantastic. That's the spirit. No problem.
Hi, Rob.
It says it.
Hi, Rob. This is Mo.
Yes. Hi, Mom.
Did you hear me fine?
I do.
James is in the room. James is just after you.
Oh, that's great. James is after me. So for those of you, oh, that's fantastic. James is absolutely super awesome, magnificently brilliant. If you're here right now, you're going to want to stick around and listen to James. That's going to be a treat. I've known James for a long time, so don't miss his book, don't miss his presentation. Let's go through some questions that come through, and then in about 3 or 4 minutes, we'll give time for James to test his microphone and whatnot. Let us know where you're from today. Type in the country or the city that you're joining us from, and let us know where you're from. Yakui asks, Rob, what do you think of the T-bond bubble and possible demise of the dollar? I think it's overblown. I don't think that's gonna happen this year. If something like that happens, Yakui, more likely to happen later on in 2011. We have Moss here from Sweden, Mike from Mallorca, Nick, Phoenix, Alvin Wong, Koala, KL, awesome, Medford, Oregon, London, Kuwait, Ohio or in Kuwait, that's awesome. How does Brazil fit into your picture of safer countries? I'd love to answer that, Carl. I'll come right back to that. Portugal, Italy, Blackbird, buongiorno, come stai? Sarò in Italia, a Roma, a giugno. I primi giorni di giugno. Il secondo e il terzo di giugno. Jim, hey Jim. Paul Volker is joining us from Houston. Paul, Melbourne, Barcelona, of course, Istanbul, Baltimore, Chicago, Oz, Berkeley. I love Berkeley. Greece. I love Greece. Excellent. There was a question about something really cool and important that came from Chicago, and it was about Brazil. How does Brazil fit into the picture? And the frank and honest and open response is, I don't know anything about Brazil. I don't know anything about it. I'm inclined to think that the South American economies, in particular Brazil, that has a huge amount of natural resources, are going to be, it's more easy to see them as clear winners over the longer term because they have so many natural resources. So, Tokyo, konnichiwa! Make sure you go to robbooker.co.jp. Maryland, Madrid. That's just fantastic. It's wonderful to have all of you here from all over the world, and Nigeria. It's just fantastic to see you here from all over the place. I have no idea where Barranquilla is. I don't know where that is, but that sounds awesome. Mauricio, ¿dónde está Barranquilla? Where is that? India. Wonderful. It's in Colombia. Only the best beans for my coffee. All right. Can you talk a bit about the ITC online? That's a perfect topic of conversation for right now. Let me pull that up. Let me go to a web page here. Okay. Traders Conference. Here we are. You should be looking at my web page. Let me know if you were able to see that web page here. If you missed going to the International Traders Conference in Barcelona, which was, again, spectacular, FXStreet.com had the brilliant idea, led by my friend Marcus Heitkotter, my good friend, to do the same conference but do it online and update some of the material for an online version of the conference. And that is going to be held April 6th through the 8th, 2010, less than 1 month away. And the same speakers that you got to hear at the ITC will be available, and we'll be holding the conference online. It's just at a price that is unbelievably low and impossible to miss, and definitely worth hearing those presentations. I will note that my prediction for the euro has already come true since that conference. It has already come true, and I will be making another prediction on the euro at this online conference during the panel discussion.
Right there.
And I want to hear from the rest of the panel members. They all thought the euro was going to like $1.75 or $1.65. And they thought the Australian dollar was going up. I want to hear an acceptance that I was right. I want to hear a pat on the back.
That's the sound of me patting you on the back.
Just kidding. So, please attend. And it does include DVDs of the keynote presentation. All right. Wasn't there talk about oil to $150 too? Yeah, there probably was. I hope I didn't say that. Yeah. All right. Somebody did say that. I remember that. You're absolutely right. Everybody, thank you so much for spending time together with me and my secret mystery anonymous currency trading friend today. It's been a wonderful day so far. I'm so grateful for the time that we spend together occasionally. Thank you for being here. Thank you for telling us where you're from. Thank you for your questions. Thank you for all the things that you do. Remember, keep your risk low, your margin low, your leverage low, and just be as safe as you possibly can and preserve your capital. Thank you, everyone. And James, I'll turn the time over to you to, you know what, I'm not going to turn the time over to you, James. This is what I'm going to do first. Well, I still have the floor, because James would never do this himself. James Chen would never do this. Okay. James Chen wrote, let's see here if I got these up. The Essentials of Foreign Exchange Trading. Here you go. This is the paperback version of Essentials of Technical Analysis for Financial Markets by James Chen. This is not out yet. This is the new one that James wrote. It comes out, I think, in May. Yep, it comes in May, and it's absolutely spectacular. The female presenter was Valeria from Argentina. She's going to make a spectacular presentation for sure. Let's see here. That's James' new book. And then James' other book was The Essentials of Foreign Exchange Trading, and also spectacular. Eric wants to know about my new book.
Mm-hmm. So do I.
So do I. Here's my new book, Eric. I'm going to turn the time over to you. Make sure you get a copy of one of James's books. There you have it. There's my new book. I wrote it in Japan instead of writing it in the United States. Sorry. So if you speak Japanese, there's the book. So there you have it. All right, everybody. Oh, you can't see it. Oh, well, here it is. There it is, in red, white, and blue on Amazon Japan. That's the new book. Have a great day, everyone. I'm going to turn the time over to